In today's class, I want to do a special application of potential exposure using value at risk. We'll be bringing together against essentially three things from the class. I want to show you how all this stuff is somewhat connected. Then we'll get into some just actual calculations, value at risk calculations. I'll give you some basic examples, which will be on exam 1, pretty straightforward. Material you should have seen in 3013 and maybe in other classes, but just to remind you how to do the basic math for value at risk. But then we'll expand it to much more practical, useful problems where we incorporate correlation. Those examples will be on exam 2, so you'll have to come back to this when you get ready for exam 2. But bringing in correlation, which is pretty critical. We'll talk about correlation in the next couple of classes, and where correlation and our assumptions about correlation can really lead us down the wrong path. But it is a very basic concept in finance, how we use correlations to manage risk. You saw that in paper 1, many of you looking at your banks, where you could see that their value at risk was significantly reduced because what they call the diversification effect. So it's definitely a huge part of finance. So maybe today we'll get into it. We'll see. It might be a little bit more of just introducing the formula to you today. We'll see how far we get. So last class, I brought in the 10-year Treasury yield. This is the 10-year Treasury back to 1962. And I took the change in interest rates in basis points. So this is the change in basis points. Remember, a basis points is 1/10,000ths. Or 1 basis point is 0.01%. So 100 basis points 100 basis points is 1%. So that's 3 basis points, 4 basis points. The other thing I did here is I did this over a weekly change. You'll see why I did that. So here, interest rates fell 3 basis points, but over the week, they only fell 1 basis points. Here, interest rates fell 1 basis points on this day, but they were up 5 basis points over the last week. All right, so there's my two columns. So when I come down to the bottom, we can see on average interest rates have fallen essentially zero basis points. 0.02 basis points, which is, 0.0, I don't know if I can do it, 0.0002%. So the average is really small because we're doing many days since 1962. So it's true, interest rates have fallen from 4.4% all the way down to 1%. But when you spread that over 15,000 days, that's only 0.02 basis points. But the standard deviation is 6.5 basis points per day. On a week, the standard deviation is 15 basis points per week. All right. The worst case, the most we've ever seen basis points fall in one day is 18 basis points, and that's probably during the 2008 crisis. 2020 crisis. Let's see. Well, this is a 1% worst case. Let me show you the actual worst case, because I do think that's 2020. So let me do the minimum here. And we'll see. I'll talk in a second why I'm worried about rates falling. So min is 75. That is probably back in the early 80s, I would guess, because that's interest rates were so high in the early 1980s that you probably saw some really, let's see if I can find it. Sorry, I'm making you dizzy here. So in the early 80s, there's a 59. So remember, there's a couple ways I could have stated this. I stated as change in basis points. I could have stated as the percentage change in the yield, because obviously 20 basis points with interest rates of 14% is not the same as 20 basis points with interest rates of 1%. But anyway, I'm doing it in basis points. There might be a better way I can do it. Over a week, we've seen interest rates fall as much as 136 basis points in a week. And again, I would guess that was probably in the 80s. I'm not seeing it here, but probably in the 80s. you can see some pretty big weeks. Look, there's a week where interest rates fell almost 50 basis points from 11% to 10.5%, pretty dramatically. But anyway, you can see that when rates are really high, that the amount of basis points change can be really quite significant, and that's just because you're starting from a much bigger base. But I'm doing this and changing, and this is the way I did it at work, so I'm going to show you the way I did it at work. You could argue that maybe there's a better way of doing it. Here you can see a pretty big week. Interest rates went from over 11% down to 10.5%. Now, this last COVID, we definitely saw some huge drops, and these were pretty dramatic drops because interest rates are so low. So look at here, we went from 1.27% to 0.82%. You can see over that week, boy, it was huge. So when interest rates are already very low, and you saw interest rates get down to 0.5%, somewhere back right here. So you can see that was the most dramatic of all. That's pretty radical. We went from well over 1% to 0.5%. So interest rates dropped in half. So think about that. You're going from 11% to 10%. That's 1% or 100 basis points, but it's not a huge percentage change. You go from 1% to 0.5%. It's only 50 basis points, but your interest rates dropped in half. So I'm doing the way you may not like the way I'm doing this, but this is the way I'm doing it. So there's the absolute worst case, but we're going to do a 1% case. So here I'm using the percentile function, telling me, give me the 1% change. So 99% of the time, interest rates fall less than 18 basis points. 1% of the time, they fall 18 basis points or more. But we've had our absolute worst case was 75. Over a week, our 1% case was 44, but we had one week where interest rates fell 1.36%. Pretty dramatic. So how am I going to use this data? So let's think what we're talking about here. We're talking about interest rate swaps. So we were using interest rate swaps. So we were using them to manage interest rate risk. So remember when we did balance sheet immunization, we were using interest rate swaps to manage our interest rate risk, but it created a credit risk measured as potential exposure. Remember, another way of saying it, it was counterparty risk. You might remember that. So that's a special risk. So in order to reduce our interest rate risk, we had to increase our credit risk, but a very unique credit risk known as counterparty risk, which we measure it as potential exposure. And the reason it's not like other credit risk, if I loan $1 billion to IBM, they owe me $1 billion. So my risk is $1 billion plus the interest. That's what they owe me. That's my risk. That's my exposure. But with counterparty risk, sometimes I owe them, sometimes they owe me. But just because I owe them money doesn't mean I don't have any credit risk for them, because interest rates could change dramatically and suddenly they owe me. And that's what potential exposure means. It's a statistical number. It's how much might they owe you in a particular scenario. All right. And the last thing we've been talking about price risk. Well, with potential exposure, we're definitely talking about credit risk, but price risk is measured using value at risk. But here, we're going to use value at risk to measure credit risk. And some of you might notice that in your paper 1, where you actually saw value at risk coming up under credit risk. We normally think of value at risk as a measure under price risk, but here we're going to use value at risk to help us measure credit risk. So you can see how all this is integrated. So what I'm trying to encourage you, when you learn this material, try not to departmentalize it too much. Try not to put it too much in everything in its own box. Think about the theory, think about what it implies, and see if there's some way you can apply it in other places. So I knew value at risk. I'd learned value at risk many, many times. I'd seen it. And now I needed to calculate the risk we had to our counterparties on interest rate swaps. And I thought, well, how would I do that? And the first thing that came to mind is, well, I'll use value at risk. And then my thought was, well, on a swap, every single day the counterparty has to send me collateral. So if they owed me $50 million on Friday, but today they owe me $70 million. So last Friday I had 50 million, maybe I had $52 million in collateral because they owed me 50 million. So our collateral is a little bit more than what they owe me. But then today interest rates have fallen, and so today the market value is actually $70 million. They owe me $70 million. So they're going to have to add in an extra $21 million. So I have that 1 day exposure that if they can't update their margin account in 1 day, then I have that 1 day exposure. But I thought, 1 day, I'm not sure about 1 day because I've got this swap and I had Morgan Stanley and JP Morgan, and I was really worried about Morgan Stanley in 2000. That was, they were, if Lehman went under, if Merrill had gone under, Morgan Stanley and Goldman Sachs were going to go under. I wasn't worried about JP Morgan. If JP Morgan went under, it was all over. The world had come to an end. And so I was mainly worried about Morgan Stanley. But I thought, okay, 1 day, yeah, if they can't pay me 1 day, that's my exposure. I can shut down that swap and move it to someone else. But then I thought, these swap contracts are complicated. I only have a swap contract with JP Morgan. I might be able to move it all to JP Morgan, but my boss might say that's too much exposure to JP Morgan. So I was thinking, you know what? Well, one thing we were doing is trying to get more swap contracts set up so I had other counterparties I could move to. But then I even thought in a banking crisis, I might have 6 counterparties set up. There may only be 2 I feel comfortable with. So I said, I'm going to give myself a week. How much could my exposure change in a week? So that if this thing really gets away from me, how much I'm going to say I'm exposed to Morgan Stanley. And so that's why I did it on a daily basis and a weekly basis. On a daily basis, my exposure was 1% case was 18 basis points. I had $1 billion value in swaps with a duration of 30. So what is my exposure? So I take those 18 basis points, divide by 10,000, so that's 0.0018. So remember the formula. You take minus duration times the change in yields. Here I did it backwards. I did the change in yields minus the change in yields times duration. And so I took 18 basis points. I'm saying my 1% case is because remember, if interest rates fall, they owe me more. This is a pension plan. I'm worried about rates falling. So I have an interest rate swap. When rates fall, they owe me more money. So I say, okay, my 1% case is interest rates fall 18 basis points. 18 basis points divided by 10,000 is 0.0018. So minus 0.0118 is a gain. This is where I'm going to have a gain. If interest rates fall 18 basis points, I'll have a gain. But how much of a gain? Well, I multiply that by 30 years because that's the duration of my swap, and by $1 billion because that's my notional amount. So essentially what I'm saying, if interest rates were to fall 18 basis points in a day, Morgan Stanley would owe me $55 million. All right. Now what if I use the 75 basis points instead of the 80? With 75 basis points, it'd be 225 million. So it's a big difference. But my CEO and I, we agreed to a 1% scenario. A 1% value risk, not a worst case. And again, this worst case, remember, is a pretty extreme one because it was back when interest rates were 11, 12, 13%. So that was somewhat of an extreme situation. I really don't think interest rates will fall 75 basis points in a week. And we saw back in, again, 2020 is a great example where we actually saw 59 in a week and 21, 20 in a day. So, I think 2020 is a pretty extreme scenario, and there you can see we're getting pretty close to that extreme scenario with 18 and 44. What was our worst case again in 2020? I think I saw 59. So it's an extreme scenario, but we can't go so extreme that we're looking at a 1 in a trillion year event. So, but you have to decide. There's no absolute rules for any of this. You have to decide what you're willing to sleep with, because if you go too extreme, you can't do business. You'd have to have swap contracts with 100 different entities if you get too extreme. And then if interest rates really fall that much in a time when interest rates, obviously interest rates can't fall 136 basis points. if the 10 years at 1%. I know in Europe interest rates are negative, but probably not out that far, 10 years, and it's unlikely. But still, you've got to decide. There's no rules on this. You've got to decide what risk you want. So now I did it with 44 basis points. So in a week, my exposure to Morgan Stanley could increase $132 million. And that's maybe what I put aside. What if I change this to the absolute worst case we've ever seen? Then it gets up to $408 million. That's a little much. So I would have gone with the $132 million. So when we're looking at our credit exposure, which we're going to talk about credit risk here in a few classes, and you definitely saw credit risk under your bank, that was what you're dealing with. If I were trying to figure out the credit risk I had to Morgan Stanley, I was going to use $132 million. That was going to be my exposure. Now, if we had other exposure at JP Morgan with on the banking side, with our backup lines, or in our real estate company, or in our investment portfolio, I would add those other exposures on top of this 132. And then our policy was you can't have more than X amount with any one entity. And so if I exceeded that, I would have to change my swap from Morgan Stanley to another entity. So we had a very rigorous policy. I'll talk about it more when we talk about credit risk. How we handled it at UTSA, I thought it was very unique. And then we can also bring in, and we'll talk about how your banks handle credit risk and how you actually set up the limits. But this, I would compare this to our limits, our risk limits, adding in all the other exposures we had to Morgan Stanley. And if that exceeded our limit, let's say our limit was 120 million, then I would have to maybe reduce the swap from $1 billion to $800 million or something to get me down below that limit, and then have to go do more of my swap with another entity. All right, so look how you can bring all this stuff together. So, that's where critical thinking is. I just brought 3 parts of our class together to show you how you can take advantage of the tools and thoughts in finance and incorporate them in many ways. I love the theories of finance. I think they're really weak in some areas, but really strong in other areas. And you mix and match, and you find what works for you theoretically, what you can convince your boss on. And man, it's an exciting world. That's why I love so much about finance. You don't have that capability under accounting. Accounting is so rules-based and so principle-based that it's just GAAP and FASB are just dictating, this is how it's done, this is how it's done. If you're too creative in accounting, you go to jail. If you're too creative in tax accounting, you go to jail. But in finance, you can be very creative. Your risk there is you lose your job because you're too unconventional, or you get sued, so there's risk there. But at least you don't go to jail unless you steal other people's money. So there's a lot of flexibility in finance to really figure out the best way to manage risk. All right, so let's work a few value at risk problems. Before we do that, just a reminder of the process. We had the process up here. The first thing is we pick our risk tolerance. And these problems, I'll give you the risk tolerance, although there's a few places we'll actually back into the risk tolerance. We'll then use that to calculate the VAR given the expected value and the standard deviation. We'll then compare our VAR to our risk budget or our risk limit, and we'll make a decision, okay? So the type of problems I give you, I'll give you some problems where I'll give you the risk tolerance and you calculate the VAR. Those are really simple. Sometimes I'll say, I'm worried about losing this much. What's the probability of that happening? So there, you're trying to figure out what risk tolerance this loss would equate to. So you need to be able to go either way. Most of the problems I give you, especially on the exams, almost all the problems, I think I just give one where I do this second approach. And I'll give you some example questions out there that you can practice for the exam to get some, I'm assuming you know all of this, you've seen it in previous classes, but it may be a while, and so just to refresh your memory on this, I'll give you some problems so you can go out there and practice. It's fairly basic mathematics, it's not that difficult. So you'll go here, you go to the table, and remember you take 1 minus the table value because I'm on the left side of the table. Remember Goldman Sachs says their VAR is a 95% confidence level or 95% risk tolerance. I come to the insurance side, we go the other direction, we say that's really a 5% risk tolerance. So in this class, we're going to be using the 5%, not the 95. We're going to say we have a 5% risk of losing this or more.
where Goldman Sachs says we have a 95% chance of losing no more than that. So you can state it either way, but I'm going to use the smaller. So we'll use the smaller value, and we'll do 1 minus the table value. So let's practice that. So you have an uncle who wants to buy U.S. stocks. He says he has a risk tolerance of 1%. Now, what's the probability he's going to tell you that? On your project 2, you've got to come up with a risk tolerance, very subjective, but let's say he thinks it's 1%, or maybe you tell him we'll use a 1% risk, and he says, sure, whatever. He has a risk budget of 20%. So what is he saying? He wants 1% of the time he can lose 20% or more, or 99% of the time he wants to lose no more than 20%. So that's his risk budget. He's okay. Stuff that happens less than 1% of the time, fine, whatever. That doesn't happen very often. I'll eat that loss, whatever it is. But 99% of the time, I don't want to lose more than 20%. That's all I can take. So he wants to know, can he invest 100% of his portfolio in U.S. stocks if they're expected to make an 8% return and their risk is 15%? Or not. Now, most of the problems I'm going to give you on the exam are daily VARs. Remember, with daily VARs, our expected return is usually 0%. On a daily basis, your best estimate is that you'll make 0%. So get used to that. You still use a 0. It doesn't change anything. You plug 0 into the formula instead of 8%. So some students really struggle that on the exam, and I'm not real sure why that's the case. So I'll keep emphasizing it. So your risk tolerance is 1%. 1% equates to what? 2.33 standard deviations. How do we get that? So we go to the normal table, and remember, when we're looking for risk tolerance, the way I stated that 1% risk, we're looking for 1 minus what's in this table. So we're looking for 99.99. And you go through until you find 0.99. Getting close. There it is right there. 0.99, you take 2.33. You add the column value with the row value. So a 1% risk is a 2.33 standard deviation event. Remember, I do not require you to interpolate. So you say it's somewhere between 2.32 and 2.33. I recommend, if it's between two numbers, always take the higher number, given that we know, we want to be a little bit conservative, and that doesn't make you all that conservative, adding 0.01 to your amount. So 2.33, and you should just know that. 1.64 is a 5% event. 2.33 is a 1% event. Those are two sigma events that you just normally, you just know. All right, so our risk budget is 20%, so we calculate our VAR. I always like to say VAR. I always like to put the VAR in my VAR. So I recommend you just get in the habit of doing that. My VAR, 1%. I just think that anytime someone tells me what their value at risk is, the most obvious thing you want to know is, what is your risk tolerance? And so I recommend you put your risk tolerance in the VAR itself. I don't think your banks do that, but I would highly recommend it. So your 1% VAR is your mean, 8%. Remember that. We said is mean. Expected return is 8%. Minus 2.33, that's the table value, times 15%. The standard deviation. When we do that, we get negative 2695. Remember, with VAR, we always express it as a positive number. We know that VARs are losses, so we don't say that our VAR is negative 26.95%. We say that our VAR is 26.95%. So can he do that? No, he cannot do that, because his VAR, 26.95%, is greater than his risk budget of 20%. So 100% invested in stocks would be too risky for him. He needs to put some in bonds to bring that risk down. All right, so there's your first example. Let's try this second one. Your boss is interested in a new portfolio. You determined that it has a standard deviation of 8% and expected return of 6. So I switched these two. Don't let that throw you off. Just look at what I gave you. The standard deviation is 8%. Now, I should have said expected standard deviation to be more accurate. Actually, we don't know what the standard deviation in this portfolio is going to be going forward, but we expect it to be about 8%. So I should have said expected standard deviation. That would have been a much clearer and more accurate way to state that. Your boss has a risk budget of $15,000. So how did I switch it here? Up here, my risk budget was in percents. Here, my risk budget's in dollars. That's the other thing you need to be able to do, is you need to be able to switch between dollars and percents on your value at risk. All right, so I'm going to give you an example. Up here, I gave you one with percents. Here, I'll give you one with dollars. It's not all that difficult. His risk tolerance is 1.3%. So what is he looking for on the table? Well, 1 minus 0.013. So let's go find that number in the normal table. 1.3% plus 1 minus 0.013. We're looking for. So some students get a little bit off here, where they'll look for like for 1%. I have some students that for 1% they're looking for 0.999. So they're off a decimal. I don't count much for that, but I'll tell you on the exam, if you can't find the table value, it's probably because instead of subtracting 1.3%, you accidentally subtracted 13%, or you accidentally subtracted 0.0013. So 1.3% is 0.013. So we're looking for 987. So let's go find 0.987. You can see it's between 222 and 223. I always use the higher one. Oh, actually, yeah, that's it. It's between those two. So 2.223 is what I will use. So 223. So our VAR, here I actually did it. I put the 1.3 in there. VAR as a percent. Now their VAR is in dollars, so we'll have to convert, but their VAR as percent is 6% expected return. There's your expected return of 6%, minus 2.23, that's the table value we just obtained, times 8% expected standard deviation. That gives us a VAR in percents as negative 1184, or stated as a positive 11.84%. So what is that in dollars? Well, our portfolio is $225,000. So $225,000 times 11.84 is $26,640. Our budget is $15,000. The result is this strategy is way too risky. Now, what if our risk tolerance wasn't 1%? What if it was 2% or 3%? Then would it be okay? So then we say, okay, what risk tolerance could accept this portfolio? How many standard deviations is 15,000? Is that 15,000 loss from the mean? All right, so the expected return is 13,000. Our mean is 13,500. So we have a $225,000 portfolio. We expect to make 6%. So our expected value is 13,500. That's right in the middle. Our risk budget is 15,000. So we expect to make 13,500, but we don't want to lose more than 15,000. So how far is the loss of 15,000 from our mean? Well, 13,000 minus a loss of 15,000 is 28,500. All right. Now, what is our standard deviation? Well, our standard deviation is 8%. What is 8% of $225,000? 8% of that is $18,000, right? 8% times $225,000 is $18,000. So how many standard deviations is 28,500 when your standard deviation is 18,000? That's 1.58. So essentially what we're saying is the mean minus 1.58 times the standard deviation, or 13,500 minus 1.5 standard deviations times the standard deviation of 18,000 is the loss of $15,000. So what does that imply for our risk tolerance? Well, norms dist at 1.58, we went to the table, we would find 9429. So 1 minus 0.9429 is 5.71. Our risk tolerance can't be 1.3%. It would have to be really high. We'd have to be really, really happy with risk. We could say, hey, 5.71%, boy, that's a really high risk. That's probably like a single B, double B rated type of company type of risk. So yeah, we'd have to increase our risk tolerance quite dramatically. Now another way you could have done this in percents, you can say, okay, our risk budget is 6.67%. So we're okay with the 6.767% loss. So minus 6.67 should equal our mean minus the number of standard deviations times our standard deviation. You work through all of the math and you get the 1.858 that way. So you can do it in dollars or in percents, but you can see the way we do it is you put your target of what you want to lose, what you're willing to lose. You put your budget either as a negative dollar amount or a negative percent, and you say, you make that equal your mean, either in dollars or in percents, minus what you're trying to find, which is the number of standard deviations, times your standard deviation, either in dollars or in percents. And when you do that, that will tell you how many sigmas this particular scenario equates to, and that can then give you your probability. So you say, hey, I only want a 1.3% probability of losing $15,000 or more, but this portfolio has a 5.71% probability of losing $15,000 or more. It's far too risky for us. All right, let's try another one. Your boss has a $500,000 currency portfolio with a daily, so now we're going to do daily risk budget of $20,000. Here I gave it to you in dollars. You want to start trading a strategy has an expected return of 0%. Why 0%? Because it's a daily budget. And a standard deviation of 2%, maybe based on the last 60 days analysis. Whatever your banks do, your risk tolerance is 5%. Why 5%? Well, maybe because this particular strategy is uncorrelated with everything else the bank is doing or your portfolio is doing. So it's already pretty well diversified. It tends to do well when everything else is doing poorly. So you have a high risk tolerance, or maybe this is Goldman Sachs with a 5% risk tolerance. Can you move to this strategy? So our risk budget is $20,000. Our risk tolerance is 5%, pretty high. Our standard deviation is 2%, or we can convert that to $10,000. 2% times 500,000 is 10,000. The number of standard deviations, we know it's between 1.64 and 1.65. Just remember that a 5% event is between 1.64 and 1.65. I like to use the higher number. In fact, this one is right in between. So maybe 1.645 is the best answer, but I say don't interpolate. So my VAR at 5%, again, I strongly encourage you, always put your VAR number there, is our mean 0 minus 1.65 times 0.02, and that gives us a VAR of 3.3%. So VAR at 5% is $500,000 times 3.3%, or $16,500. Our budget was $20,000, so hey, we're well within our budget. We expect to lose $16,000 or more 5% of the time, or we expect to lose no more than $16,500 95% of the time. Our budget is $20,000, so we're good. We could actually leverage up this strategy a little more, take on more risk, get a little bit higher expected return annually. Our daily will probably not change, but our annual return would change. Or we could try to we could go to the lower risk. So here we say our VAR equals 0 minus number of standard deviations, so that's 10,000. We know that our budget's 20,000. So instead of VAR, we put our budget. We say 20,000 equals 0 minus number of standard deviations times 10,000. We say what risk tolerance could we get? That would be 2.28 if you did that. So yeah, so you got a standard deviation of, you got 20,000. You want this formula to give you 20,000 because that's your risk budget. Remember again, I'm leaving out the negative number. You can put the negative number in there, but so if you get confused, you know, I'm actually, the negative numbers in there. VAR is always a loss. So negative 10,000. So when you do the minus sign here, the minus signs cancel out. So you have 20,000 divided by 10,000 gives you your number of standard deviations. That's 2. If you look in the table, a 2 sigma event, there it is, a 2 sigma event. So you take plus 1 minus that 2 sigma event, and it gives you 2.28%. your risk tolerance is 5%, but this particular portfolio only has a 2.28% chance of losing $20,000 or more. And so you can see what I'm in. Let's go back up here and see what I'm in. What you have to be able to do type 1 problems is you just calculate the VARs. Most students, 90% of students get 100% on those problems. The second one is your boss says, okay, well, it doesn't meet my risk tolerance, but what risk tolerance would it have? And then you have to back into that. And the other thing, you need to be able to switch between percents and dollars. If you can do all 4 of those combinations, risk, the VAR and dollars or percents, figuring out the risk tolerance and dollars or percents, if you can do those 4 things, then you're good on these basic kind of problems. And hopefully this is good review from what you've done before. So let's do one more just to get us a little bit more practice. And then I'll give you those extra problems you can practice, and if you can just see how good you're getting at them. So you are a risk manager at AIG. That is probably something you do not want to put on your resume. The guy who took my place at UTSA, he came from AIG, and it was interesting in the interviews. He would start off by saying, yeah, I worked at AIG, but it wasn't my fault. I wasn't in that area. So this is back. Greenberg had a reputation very similar to the boss I had when I was at UTSA, the CEO then, of being somewhat of a micromanager, really down into the nitty-gritty details, which is probably what made AIG such a great company. You should look back at the history of AIG. I think, if I remember correctly, you can go back and check on this, but AIG had 2 CEOs over a 70-year history, and Greenberg was the second one. And a lot of people believe that Greenberg leaving AIG is the reason it went under. They lost that nitty-gritty, daily, in the weeds, detailed assessment of risk. And when he left, this new CEO was not nearly as particular as Greenberg was in managing risk. There's a downside to that kind of micromanaging, no question, but there is a positive side to it. But let's say this is during their good years, and you're a risk manager at AIG. They have a risk tolerance of 0.5%. All right, so let's go figure that out. This is a really good. This is one where students do have a problem getting the table value. So 0.5%. So 0.5% is what? 0.5 divided by 100 is 0.005. So you take +1 minus 0.005. We're not looking for a 95% event, 0.95. We're not looking for 0.9995. We're looking for exactly 0.995. So let's go find 0.995. And it's somewhere between 2.57 and 2.58. I always use the 2.58. I use a higher number. Now when we do your project 2, we'll actually calculate it out. I say don't interpolate, but in project 2, you'll use the actual Excel formula that will tell you exactly how many standard deviations this is. So we'll actually get out the thing I said not to do. We'll actually do, just because why not? It's in Excel and you can do it. So 2.58. All right. You have a daily risk budget of 100 million. You can kind of guess that your expected return is 0%. Your standard deviation is 3 million. The notional value. Now, when you see notional value, remember we talked about this with potential exposure. That's the number you want to use in your risk budget, because the notional amount, even though you don't have that much invested, it's not your market value, it will determine how much risk you have, how much your portfolio is going to move. So anytime you see notional amount, use that just like we did up here with the portfolio value. A $500,000 currency portfolio, that's going to determine your risk. The notional amount will determine your risk. That's what I did with potential exposure. I used the notional amount of my interest rate swap. All right. So you're going to meet with Mr. Greenberg tomorrow, which would be pretty cool to be able to do that. And you want to say, hey, can we do this? And I have credit default swap department, which was the department that put AIG under. So I'm a little tongue-in-cheek here. I'm kind of making this up, but it's a little humorous. I don't think Greenberg would have ever had a credit default swap department. So your risk budget's $100 million. Your risk tolerance is 0.5%, 3 standard deviations. So we're using 2.58 standard deviations. Our standard deviation is 3%. Our number of standard deviations is 2.58. Again, I used to tease the accountants that would call me for these numbers because they would mix these two things up. They say, what's our standard deviation? And I would say, well, it's 15%. They say, no, not that number, the other number. And I kept telling them, they were so busy, so stressed, they just like, give me the number. And I was like, hey, go into depth, know what these numbers are. But they were in the department where they were pulling numbers from so many different areas, they just didn't have time to get into that. But boy, I encourage you, if you're not stressed out, if you have the time, or even if you are stressed and don't have the time, still at least every once in a while ask, hey, what is this number? Where does it come from? They just were not interested in that. So the standard deviation, and remember again, it's not the standard deviation, it's the expected standard deviation. We don't know the actual standard deviation. We just have an expected standard deviation. I should do that every time, but I don't. It's 3%. And our risk tolerance, 0.5%, gives us the number of standard deviations, the type of sigma event we're interested in. So our VAR, again, there's that 0.05%. I put that right in the VAR. It's 0 because we're doing a daily VAR, so our expected return is 0, minus 2.58, that equates to the 0.5 risk tolerance, times our standard deviation. Here I left a negative sign out. I know it's a negative, but again, I'll leave that out. It's 7.74%. So 7.74% times 4 billion is 310 million. Our budget's only 100 million. We're going to tell Greenberg, hey, we can't do this portfolio. It's far out of our risk tolerance. What risk tolerance would be acceptable? Then here you say you put your budget in there, $100 million equals our value at risk times $4 billion, R. We're talking about, so you take $100 million divided by the 4 billion. You're talking about a 2.5% budget. That's the most you can lose, 2.5% or $100 million. So you say we can lose 2.5%. So that's your target. You put your risk budget on the left-hand side as a negative number. A 2.5% loss equals our expected return 0 minus number of standard deviations. That's what we're trying to figure out here. Times 3%, and that gives us number of standard deviations of 0.83, and that equates to a probability of 20.3%. So we can go look up 0.83. 0.83, there it is right there. So we do +1 minus that number, and we get a 20.3% event. So there it is, 20, way out. I know who's going to have a risk tolerance of 20%. You might as well just, you know, just go to Vegas and start gambling. It's just a very, very extremely excessive risk tolerance. All right, so hopefully you're seeing on the first exam, the majority of the problems will be the very simple, give me the VAR, and you compare it to your risk budget. Sometimes you'll have to do it in percents, sometimes in dollars, but that's going to be the majority of the questions on the exam related to value at risk calculations. But every once in a while, I ask you to do the second one. Remember, on the second one, you put your risk budget in, either in percent or in dollars, and that's going to equal your mean minus the number of standard deviations. This is, you know, times your standard deviation. This you'll have, that'll be given. This you'll have, that'll be given. And what you're going to do is you're going to calculate that, and then you go find that in the table, and that will get you your risk tolerance. Okay, so be able to go either direction with these problems, and you'll have plenty of places to practice them. All right, so plenty of problems here. Hopefully you'll be really good at this. I did some of this at USA. There were some times where one thing we did is on catastrophe risk, I think we talked about this in a previous session, but the actuaries would give us the catastrophe risk, our risk to hurricanes and earthquakes and those type of things. My responsibility was to come up with the value at risk for the investment portfolio. So the actuaries would do stochastic VAR. They would run simulations, 1 million simulations, and they would say, okay, we had a 0.2 risk tolerance. They would give us that 0.2 event equated with all those scenarios that they ran. That might be $3 billion, who knows what number. And then my role was to add an additional market risk on top of that. And so I did a 10% risk tolerance. Now, why so high? Well, the thought process was catastrophes are unrelated to stock markets. except for in the extreme. When we have a really bad catastrophe, we're talking about a 1 in 500 year event. That's probably going to impact the stock market and bond market somewhat. It may not be an extreme case for the stock and bond market. So you go to the Tokyo earthquake. If you go back to that event, definitely that did drive stock markets down. But it wasn't an extreme event like we saw in 2020 or in 2008. But it was a pretty bad stock market. About a 1 in 10 year type event for the stock market. And so what I did is, on top of the value at risk that we got from the catastrophes, I added a 1 in 10 year event for the stock and bond market. I actually had stocks, bonds, and real estate all together. And so I did it exactly like this. I assumed the normal distribution. And so I did exactly what we did. It was a rough, kind of a high level guess, but with a risk tolerance of 10%, normal distribution is actually going to give me a pretty accurate number. And so I did. So I'm calling these basic problems, but there are applications to these basic problems. However, we can do much better. And I'm going to show you much more real life to what the kind of problems we did in my career, bringing in the concept of correlation. So what if you have more than one thing to allocate to? So you saw with JP Morgan, they had interest rates, commodities, the stock market, currencies. They have all these different things, and they want to figure out the risk of the combination of all those things. But each one of those is a different department. They're not all together, and it's unlikely all of them are going to be at their 1 in 20 year scenario all at the same time. They're not all perfectly correlated. They don't all have their bad down event all at the same time. So, when stocks are down, it's a pretty good chance bonds are doing okay. Stocks are down, it's probably uncorrelated. Correlations might be doing well, might not be doing well, unrelated. It's probably true that if stocks are down, commodities will be down, but it's not a perfect correlation. So just because stocks are way down, commodities may only be down a little bit. So we're not sure how to combine all these things together, because they don't all move together. And so what we got to do is take in consideration correlations. If they were all correlated 1.0, perfectly positively correlated, then yeah, we could just take the 5% event for each one of them and just add them all together, and that would tell us our 5% risk for the entire corporation. But because they don't all move exactly together, then you have to bring in correlations. So that's why at UTSA, with the catastrophe risk of 1 in 500, I added a 1 in 10 year portfolio of risk, because we did say those two were correlated. They were related. If we have that big of a catastrophe, it's going to drive markets down to about a 1 in 10 year event. So we said there is some relationship here. We'll bring them together in a very simple way. So how do we actually do this in real life? So this is a formula. I hope you all know this formula from heart. If you don't know this formula by heart, you better learn this formula. Finance especially, but I think even actuarial science majors would know this formula too. Actuaries say it's not sophisticated enough. We have to do something much more sophisticated than that. But in finance, we use this formula a lot. So if you're a finance major and don't know this formula, then I'm warning you, learn it now. Don't memorize it for the exam. Learn it forever and ever and ever. This is an extremely important formula. I used this formula millions of times in my career. I mean, spreadsheets where it was just going on over and over again. And I'll actually show you this formula when you do project 2, because you'll be using it quite a bit. So let's just look at two things. Let's say all JP Morgan had was interest rate risk and stock market risk. So how would they figure out the combined risk of those two things? Well, they take the weight of the first one squared times the standard deviation of the first one squared plus the weight of the second one squared times the standard deviation of the second one squared plus 2 times the weight of A times the standard deviation of A times the weight of B times the standard deviation of B times the correlation of A and B. You take all of that and take the square root. Now I say weight here, weight squared. Usually weights will be in percents, but they can be in dollars. All right, so if they're in dollars, we do it a little bit differently. And so you'll see, there's different ways you can do it. I have the problem set up so you can see. But the first thing I want to do before we even do that is I want to show you what we're going to be doing in Project 2. Now in Project 2 I have this all set up for you, but I want to show you how I had it set up so you can see what I did in Project 2. And then in a few classes I'm going to actually show you Project 2 and you'll see this formula at work. But we're going to try to build an efficient frontier with just 2 assets. All right, and then we get into the problems for the second exam that are more complex. We'll do that next class. When we get into these more complex problems, you'll just see the incredible power of this. And this is stuff I actually did in my job. We did this several times. I'll give you some real life examples how we did this. So we're getting to the point now where now you have something you can do something with. You can actually sit down, entry-level finance, use the skills I'm going to show you right here, and you can actually help your firm make a decision. So let's get into this. This could be really exciting. We're in the big leagues now. So let me set up a portfolio. Let's say we have some bonds, we have some stocks, and we have an expected, and you might actually try to build this with me. So get into Excel and try to build this with me. I'll try to go slowly enough you can keep up with me, but if not, just hit pause every once in a while. And we have an expected risk. I'll pretty it up as I go so you can catch up with me. Let's say on bonds, interest rates are pretty low. Let's say we expect bonds to make 4%. And let's say we expect stocks to make 8%. And let's say the risk of bonds is 4%. It's pretty well balanced. And let's say the risk for stocks is 16%. I might not like this number because there's one point I want to show y'all that might not, I should do this in advance because I want to show you a real famous looking efficient frontier, and these particular assumptions may not get that to me. All right, so the first thing we want to do is get expected return of this portfolio. So what's my expected return? Well, I got to know, let me move this down. I got to know what my weight in bonds is, and I want to know what my weight in stocks is. All right, well, my weight in bonds could be 100%. My weight in bonds, let me just subtract 10%. My weight in bonds could be 90%. So I just take my 100% weight and subtract 10%. So my bonds could be anywhere from 100% down to 0. What is my weight in stocks? Well, my weight in stocks is 100% minus whatever I have in bonds. For my weight in stocks is 0% all the way up to 100%. So what is my expected return? Well, my expected return is going to be my weight in bonds times my expected return in bonds. I got to lock that in with the dollar signs, plus my weight in stocks times my expected return on stocks. So if I have 100% in bonds, obviously my expected return will be 4%. I can copy that over, and you'll see when we get up to 100% in stocks, our expected return is 8%. So expected return is just the weighted average of the weights times, the expected return. It's very simple. You did that expected return. You should have seen that in an earlier class. Now, what about my risk? Well, for my risk, I've got to figure out the correlation of bonds to stocks. Well, I'm going to run 3 scenarios. Scenario 1 is that they're perfectly positively correlated. My scenario 2 is that they're uncorrelated. And my scenario 3 is they're perfectly negatively correlated. They're completely uncorrelated. When stocks are up, bonds are down, and bonds are down. We'll talk about this correlation because that's going to be an important concept. And so what is my risk? Well, remember the risk is the square root of the weight of A squared times its standard deviation plus the weight of B squared times its standard deviation squared. I forgot to do squared. So standard deviation squared plus 2 times the weight of A times the standard deviation of A times the weight of B times its standard deviation times the correlation of A and B. So we're running out of time here, but let me do it real quickly. So let's set this up. So we have the weight of A squared, that times the standard deviation of A squared, that times the weight of B squared, that times the standard deviation of B squared, that times that, plus 2 times the weight of A times the standard deviation of A, lock it in, notice how I'm locking it in, times the weight of B times the standard deviation of B, lock that in, times the correlation of A and B. We're going to take the square root of that. We should get, if I do it right, we better get 4%. And we go to 100% in stocks, we should get 16%. The question is that I do it right in between. And in between, what you'll notice is if I just take 90% times 4% plus 10% times 16%, I get 5.2. I get the exact same numbers. What we're saying here is when correlation is 1, there's no diversification benefit. The risk is just a straight line up. All right? So there's scenario 1. Let's try scenario 2, and we'll finish this up next class. So let's try scenario 2. Well, what do we need to do for scenario 2? Well, let's bring this formula down. And what we'll do, everything is the same. We're just going to change our correlation to 0. Now what happens? Well, the ending points are exactly the same. But what happens in between? Well, you notice your risk is much lower, and it actually declines. The risk actually declines to start with, and then it starts coming back up. Pretty amazing. Now let me do scenario 3. Scenario 3 might give me an error formula, error, and we'll see. Hopefully not. So we'll use this exact same formula. We'll bring it down here. Again, my ending points will be the same. Now what's unique with a -1? We'll see what we get. I have no earthly idea. Ah, perfect. Wow, couldn't have done it better. The unique thing we get here, when correlation is -1, we can actually have a 0 risk portfolio. All right, so next class what I'm going to do is I'm going to graph this so you can see the traditional efficient frontiers. So we'll do some graphs next class so you can see how these work. And I'll try to set up the graph in a way that you can really see the dimensions of this. You're going to build an efficient frontier in project 2, and we'll do a little bit of experimenting with this so we can just see how what this means theoretically. I want you to actually visualize the theory as we do this. So I will leave the formula. You see the way I copied the formula down? I got the formula exactly like I wanted, and I like to do this. I don't want to copy it down because then everything gets messed up. So what I do is I take the formula and I put apostrophe at the beginning of it, and I copy that down, and I go back, take the apostrophe out, and then I take the apostrophe out here, and then all I have to change is correlation. So that's the way, that's what I was doing if you couldn't keep up. I will put the formula down here at the bottom so you can see it. So if you want to pause the video so you can see everything I did, you've got it now. You can see what I had to lock in, where you need the dollar signs and where you didn't. So you have everything lined up. So next class what we're going to do is we're going to focus on graphing this, and then we're going to take this and I'm going to give you some real life problems just like you'll see on the second exam, and we'll get into the big leagues.